Welcome to my channel, where I talk about AI, tech, and the stock market daily. Today, I wanted to explore something that's a bit broader but incredibly impactful: the economics of emissions credits. These markets are shaping not only environmental policies, but also influencing economies, corporations, and global trade. We're going to look at how emissions credits work, how they've evolved, and how they're performing both ecologically and economically as of November 2024. Let's take a detailed look at the opportunities, challenges, and trends shaping this multi-billion-dollar market. To start, emissions credits are essentially permits that allow companies to emit a certain amount of greenhouse gases, usually measured in metric tons of carbon dioxide or its equivalent. Think of them as tradable certificates designed to put a price on pollution. These credits are a core part of cap-and-trade systems. Governments set a cap on total emissions, and companies are either allocated or must purchase allowances to cover their emissions. If they reduce emissions below their allowance, they can sell their excess credits to others. It's a market-driven approach to addressing climate change, incentivizing companies to find cost-effective ways to reduce emissions. Now, emissions trading isn't new. The concept dates back decades, with the Kyoto Protocol of 1997 introducing mechanisms to promote market-based solutions for reducing greenhouse gases. But the system gained serious momentum in 2005 with the launch of the European Union Emissions Trading System, or EU ETS, the largest carbon market in the world. Since then, we've seen cap-and-trade systems pop up in California, South Korea, New Zealand, and more recently, China. These markets now cover a substantial percentage of global emissions and represent a growing sector of economic activity. Here's what's happened recently. Global carbon markets have been growing at an astonishing pace. By 2023, the market's value surpassed $1.1 billion, and projections suggest it's only the beginning. Companies are scrambling to either comply with emissions regulations or to meet voluntary sustainability goals, especially as pressure from investors and consumers mounts. This has spurred demand for carbon credits. The market is becoming increasingly sophisticated, with exchanges dedicated to trading credits, such as the European Energy Exchange and China's National Emissions Trading Scheme. In terms of international cooperation, one of the most significant developments this year came out of COP29 in Baku. Negotiators reached agreements that finalize rules for a global carbon trading system under the Paris Agreement. This means countries can now trade emissions reductions more freely, creating what some are calling the next frontier of international climate policy. The goal is to channel investments into projects that achieve genuine emission reductions while driving down costs. From an economic perspective, emissions credits are fascinating. They essentially place a monetary value on something that was previously treated as external to financial markets pollution. This pricing mechanism creates incentives for companies to innovate. If a company can cut emissions at a lower cost than the market price of carbon credits, it can profit by selling its excess credits. This dynamic pushes businesses to invest in energy efficiency, renewable energy, and carbon capture technologies. Take the EU ETS as an example. Over the last decade, it has faced its ups and downs, including a price crash in 2008 and significant reforms in 2018. Today, the price of carbon under the EU ETS has stabilized at a high level, hovering around €90 per ton. This has had a tangible effect. Companies in Europe have been adopting cleaner technologies and shifting away from coal. Emissions from sectors covered by the EU ETS fell by around 35% between 2005 and 2023, showing that a well-designed system can achieve meaningful results. On the corporate side, companies are not just looking at emissions credits as a compliance tool. Many are using them voluntarily to meet net zero commitments. Major corporations like Microsoft, Amazon, and Shell have announced plans to offset their emissions through credits while also reducing their operational footprint. This dual approach is critical, but it has also sparked debates about the integrity of the offsets being used. Are these credits funding real, additional emission reductions, or are they a convenient way to greenwash? And this brings us to one of the major challenges facing emissions credits: ensuring integrity. The concept of additionality is key here. For an offset project to truly contribute to emission reductions, it has to fund activities that wouldn't have happened otherwise. However, critics argue that some projects, like reforestation, often receive credits for outcomes that would have occurred without the funding. This undermines the credibility of the system and its ability to deliver genuine environmental benefits. Another major criticism is price volatility. Over the years, carbon markets have experienced significant swings. For instance, in the early years of the EU ETS, carbon prices dropped to nearly zero because of an oversupply of credits. Even now, as markets mature, prices can fluctuate due to regulatory changes or economic conditions. This unpredictability makes it difficult for companies to plan long-term investments in green technology, which ideally require stable and predictable pricing signals. On the ecological side, emissions credits are a mixed bag. When done right, they can lead to substantial reductions in greenhouse gas emissions. The EU ETS, as I mentioned earlier, has contributed to a marked decline in emissions within its regulated sectors. But the ecological impact of voluntary carbon markets is less clear. Many projects funded through voluntary credits, such as forest conservation or renewable energy installations in developing countries, do provide benefits, but they often fall short of the rigorous standards required for compliance markets. Interestingly, some of the most promising carbon offset projects also deliver co-benefits. For instance, reforestation projects not only sequester carbon, but also improve biodiversity, prevent soil erosion, and enhance local livelihoods. Similarly, clean cooking stove initiatives in developing countries reduce carbon emissions while improving air quality and public health. These co-benefits make carbon credits an attractive tool for achieving multiple environmental and social goals simultaneously. Now let's talk about the economics of scaling this system globally. A global carbon market, as envisioned under the Paris Agreement, could unlock billions in investments for climate mitigation, but it requires robust governance. Double counting, where the same emissions reduction is claimed by multiple entities, is a persistent issue. Strong international frameworks are needed to ensure that credits are genuine, additional, and transparent. And then there's the question of accessibility. Most carbon markets are concentrated in high-income countries, while low-income nations, which often have the most affordable opportunities for emission reductions, remain underrepresented. Bridging this gap could be a game-changer, both for reducing global emissions and for promoting sustainable development in less industrialized regions. In 2024, one of the emerging trends is the integration of blockchain technology into carbon markets. Blockchain can enhance transparency by providing an immutable ledger of transactions, making it easier to track the life cycle of a carbon credit. This could address many of the integrity issues that have plagued the system and build trust among participants. Several pilot projects are already underway, and the technology holds promise for scaling carbon trading. However, emissions credits are not a silver bullet. Critics argue that they allow companies to delay making the deep systemic changes needed to achieve real decarbonization. Buying credits is often cheaper than investing in new technologies or changing business models. As a result, there's a risk that companies might rely too heavily on offsets rather than addressing the root causes of their emissions. To sum it up, emissions credits are a powerful but imperfect tool. They've already contributed to meaningful emission reductions, particularly in regulated markets like the EU ETS. They've also mobilized investments into clean technologies and provided co-benefits for communities and ecosystems. But challenges remain, from ensuring the integrity of credits to addressing price volatility and the risk of greenwashing. The next few years will be critical for the future of carbon markets. As the world moves toward more stringent climate goals, the demand for emissions credits will likely increase. Whether these markets can rise to the challenge will depend on their ability to address existing flaws and scale effectively. If done right, they could play a pivotal role in the global fight against climate change. If you enjoyed my analysis, please subscribe to my channel. Thank you, and see you next time.